Hey everyone, welcome back to another Stock Market Open Live, starting a little bit later today, but wow, we've got some crazy news out of China. We did a full video on it already this morning, breaking down the stimulus bazooka of what we've seen in China, and it's stoking new inflationary concerns in an environment where, frankly, we're still probably facing deflation. Now look at AutoZone that just reported missed estimates, comp sales half of what the expectations were. Really not excellent. Now, my belief is that we're going to be in an environment where we continue to see softening earnings, weakening earnings per share, and unfortunately slower growth, which will be marked by really disinflation and eventually deflation. But yesterday's PMI report had a little hint of inflation in it. Add to that little hint of inflation, Goolsby suggesting we're going to cut huge, and add to that what China pulled off today, which is frankly seen by many as hyperinflationary. You've unfortunately got a lot of people who are going to make trades that say, you know what, it is time to prepare for potentially stagflation or the next wave of inflation. And that's why right now what you're seeing is, frankly, gold mostly flat in the face of oil up about 2%, which would be an inflationary impulse. You're seeing bond yields across the board higher, again, because of, okay, well, if central banks are printing money, we're going to see inflation again, right? Not necessarily. You usually see inflation when you start printing money and handing it out to people in terms of like your consumers. This sort of backstop of markets has happened before in the United States. It happened in 2009, it happened in 87, and it happened in 2003. And these backstops of markets are not necessarily inflationary. But in the short term, people trade them as if they're inflationary. I actually see them as more of a sign that we're so close to larger economic crises that central banks around the world are trying to get ahead of the pain that they frankly see is on the horizon. Now, whether they'll be able to, well, that might be a coin toss, but we'll see. We did also just have Bowman talk, so I want to see, as the only dissenting vote, what Bowman had to say. We're going to go through this. I do want to mention, just because it's coming up a little bit, stock hack. A lot of people are wondering, hey, what's stock hack? You know, why does it cost money? Well, first of all, let's just be clear. We've opened this up to signups now on a first come first serve basis. You can either sign up or book an intro call. If you have enough information from the video, you could sign up for stockhack.com, actual wealth consulting. If you have questions, you can book an intro call and see if it's right for you. But a lot of people get stuck, just a quick note on this, a lot of people get stuck on, oh my gosh, I can't believe I have to pay for a consultant. Well, keep in mind, you're paying no commissions, no hourly fees. You're paying a flat fee, optional on asset management. You're paying a flat fee. It's a $420 a month investment. And for a lot of folks, especially those trying to expand their real estate portfolio, trying to expand their wealth or diversify or balance whatever it is they're going through, this is a bargain for getting direct wealth consulting and building out a wealth plan and being able to grow your wealth with a wealth advisor. Now, that doesn't work for everybody. I mean, if your net worth is $2,000, obviously that's not for you. Obviously, it's going to scale to a higher end consumer at this point. But it's interesting because there are a lot of, I see comments are like, oh my gosh, $420. It's like $420 to pick up the phone and text or call your consultant at any point without getting charged hourly. It's a drop in the bucket. It's cheap. We actually think the service is going to end up being too cheap. But it's interesting. I just wanted to mention that's available now, and I know some people had questions about it in terms of why the structure is what it is, and that's why we would just want to make pricing very transparent and simple. Okay, so let's go into what's going on with Bowman here. So if we look at Bowman, she just spoke. Bowman, who was your dissenting vote at Fed. She just started yapping, and she says she sees greater risks to inflation than labor market. She thinks we are uncomfortably above the 2% inflation target. Now, this, I think, is like from the straight-up loony bin. She remains cautious on future cuts. She sees resilient GDP, must not be looking at the actual data that's coming out. She says the labor market is not showing signs of showing clear trend of weakness. Okay, well, this is basically a way of trying to say, oh, I know the Challenger report was bad, but it's not a trend yet. Okay. So, I mean, this is unfortunately just in the short term for any bond investors going to hit bonds. You're going to see yields go up, but really what you're doing is people like Bowman are just delaying the inevitable of more pain in financial markets through the potential for substantial labor market weakening and maybe even a recession. So it's crazy, but that's Bowman for you. 10-2 yield right now is what are we at now? I think we're like 20 basis points right now. So he says 420 a month is high, even someone with 7-digit net worth. Well, I totally disagree with that, but I mean, if you think about it, as you said, $6,000 a year. I mean, if you had $1 million net worth, you're literally paying 60 basis points to have unlimited access to a licensed financial advisor and people on my team. Quite frankly, if you think that's high, you shouldn't buy the product. Don't buy the product. Don't get a consultant. Don't have an actual advisor that you can text or call at any time. Like, that's okay, right? So if you think that's too high, please don't buy it. It's okay. Our goal is to provide a premium service. Somebody here says, what do you mean no commission? There's 0.69 in fees, way less than I play at Vanguard. Yeah, exactly. If you want a passive index fund, you should just invest in Vanguard. But an AUM fee is not a commission. A commission is what you pay when somebody trades, right? So it's like, oh, I'm going to put $1 million trade in, you pay a commission. It's kind of important to be clear with definitions and use logic here, but it's okay. Some people won't do that. Somebody here says, we're in a recession. Just wait till you lose your job. Well, that's yeah. I mean, that's honestly a big deal there. Somebody here says, "Rip Kevin shorts." I don't have shorts, so thanks, slot hits. Delusional loony bin people who think, oh, just because someone's bearish, you must be full of puts. No puts. Kevin saying second wave of inflation now. No. I think there's no second wave of inflation. I think that's what Michelle Bowman's saying. I think that the PMIs kind of gave a little bit of a nod to that. But I think what we'll find is, and mostly this is using sort of the leading indicators that we're seeing in actual company earnings. There's no inflation. There's going to be a substantial lack of inflation, and I think it's going to lead to wage deflation. If he's too expensive, then I guess you're not going to use Kevin as an advisor. Well, there you go. Yeah, I think that's well said. If your 7-digit net worth 420 is not high, exactly. Let's see here. So yeah, and people are like, oh, I have a free advisor. Well, you get what you pay for, right? Does your advisor help you buy wedge deals? Does your advisor help you with your real estate renovations? Does your advisor help you with your loan statement when you apply for a loan for a house, or review your lease contract, or see if you should buy versus rent? Does your advisor even understand real estate, right? These are all questions that you should be asking about. See, somebody here says, I found the value of an advisor is less about investing and more about planning, insurance, taxes, assets, a plan. Right. It's a way to keep yourself accountable, right? I mean, think about that. It's entities, it's a retirement accounts, it's making sure that the framework of your life is properly set up. That's what an advisor does. An advisor isn't promising to beat the market. That's not the intention. It's to say, do you have a will? Do you have a trust? Are you setting up your businesses correctly? Are you getting a good deal on the house you're buying? These are things that advisors do, right? So let's see here. Okay, so what else do we have? Okay, so we've got Ababa running really nicely in the morning here. And yeah, you could see this sort of extra boost you're getting over here on Alibaba. I expect that like JD, the Alibabas, and a lot of, JD's doing really well too. PDD should be doing really well as well. A lot of the Chinese plays should be doing well. I'm not sure yet that we're gonna see the consumer actually react to this in China. So we'll see. That's gonna be really interesting. So, I find that fascinating. So, let's see here. Nvidia, I'm surprised that honestly the Qs aren't even moving up greater. I would have expected some of the American companies to really move a lot more on the Chinese stimulus, just because China has been seen as sort of a weak lead for demand. Leute sind so dumm, says Luke Skywalker. Yeah, well, hey, the goal always is to help people understand, right? So, yeah, Flying Investor says, just read a book. No need for a financial advisor. Yeah, well, I guess everybody knows how to buy wedge deals, and everybody knows how to build long-term wealth, and everybody knows how to build, out their retirements and their trust and protect themselves with proper insurances. Because after all, there are books. There are books. Yeah, it's always the fun thing about the internet is you're always anytime you have a business, and I think this is important to know for any business owner, anytime you have a business, that they're always, going to be naysayers. And a lot of naysayers, who all, sort of the only thing that they do is they hate on other people. They're really just pointing a finger at themselves, right? Father-in-law always used to say, if you point a finger, 3 point back at yourself. People are like, oh, that's a scam, or that's a ripoff, or whatever. People are just like exemplifying their own insecurities by trying to make themselves feel better, and what they're really doing is by talking somebody else down. They're saying, my narcissism is better than you, and I'm gonna kick you while you're down. It's really like complete retardation. But that's sort of what you have on the internet because people get to hide behind a keyboard. But anyway, if you want to learn more about that or sign up for an intro call, go to stockhack.com. We are accepting intro calls now. And or you could sign up directly if you already know enough about the service. Okay, so as far as somebody's asking about the 10-year resistance line, yeah. So like, I mean, you could look at the 10, you could look at the 20. Look at the channels that you have here. So this is the up channel that you have on something like a 20-year bond. You are moving down inside the channel right now after you rejected right on the line. It's not uncommon to get rejected on these lines because, frankly, we got rejected here, 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 here. So it's like, this happens. This is very normal. But the thing about these bond yields that I think people forget is that these bond yields actually tighten exactly what the Federal Reserve is trying to accomplish, which is a looser market, a market that enables the hiring of people. And so, yields going up is actually bad for the goals of the Federal Reserve. This is why you had Goolsbee come out yesterday and suggest, oh, we're 200 basis points or we're hundreds of basis points above where we need to be. And it's remarkable because, they're really signaling to you that, oh, like it's about to get like real in terms of we're going to have some major rate cuts coming. And I really believe that. I actually think that I think the market is presently underpricing how many rate cuts we're going to get. In fact, I wrote the following, which I thought was really accurate. We are probably just one week market crash away from the greatest Fed capitulation the world has ever seen. 50 or 25 or 50? Yeah, right. 200 will come off instantly, followed by another 200 soon after that. They want a soft landing so bad, and I wrote PS by that capitulation. So I find it very interesting. Yeah. Very, very interesting. So, let's see some other comments here. Thoughts, Tesla, I think there's a good chance Tesla continues to run going into 1010. Obviously, we think that's going to be a buy the rumor, sell the news. But, yeah, I find that very interesting. So will you be investing in a Matterport? Matterport has an acquisition. I think it's CBRE, or who was it? One of the commercial brokers wanted to buy them out. So I don't know what ended up happening with that. But yeah, I do think Tesla is probably going to run into the event. And risk assets will do well too. So crypto should do well as well going into this sort of central bank stimulus. The question is it going to be enough? That's the big question. Somebody here says NIO's up 42% in the last 30 days. That's incredible. I think a lot of EV manufacturers have run quite a bit in the recent past here. Yeah, I mean, look at Neo. I mean, what a ride, I remember in January of 2020 when I went to cash, Neo was like $20. And I remember it ran like 10%. And people were like, oh, you're such a loser. Neo went up 10%. That's $22. And I'm like, bro, I'm not touching Neo. Now it's like, yay, it's up 40%. Great. From $4 or 380 or whatever. The electric vehicle market, I think people forget, even in the face of stimulus for the stock market, is still facing substantially high interest rates. Substantially high. Bitvoyage says, I don't think Kevin sees these comments. Shake my head. Oops. Uh, so, yeah, it's as a risk play. Like, if you think the only direction is risk on, oh my gosh, go long crypto, go calls, Tesla, whatever. But I'm a little bit more of like a Jamie Dimon right now, where Jamie Dimon himself, he's talking about being cautious. He's cautious over the geopolitical issues that are getting worse. And he's also cautious about, frankly, what that could mean for the economy. I mean, here's the CNBC piece on him. It says, Diamond said in an exclusive interview, my caution is all geopolitics, which may determine the state of the economy. In other words, expanding wars in the Middle East, it could lead to really strong short-term volatility. Look at this. I'm a long-term optimist, but in the shorter run, I'm also more skeptical of other people that say everything is going to be great. Markets are pricing things like they're going to be great. That put me on the cautious side of that one. So I think this is a really great way to put it, because it's not just geopolitics, but it's also valuations in markets that are so ludicrous to some extent. It depends on which stock you're referring to. Some valuations are really ridiculous. Some stocks are still cheap. That you really are trying to price a market here for perfection. And who knows? Maybe we'll hit that perfection. So we will see. Does it matter if inflation is elevated after 1 year while you stay bearish, but market runs on? I think again people mischaracterize what I've said. I said in July that I plan to be bearish through the election, and that if I'm going to plan to go bullish, it would probably be right before the election. So I don't know how all of a sudden halfway through July, that puts you to mid-August, mid-September, mid-October. I don't know how all of a sudden 3 months of bearishness turned into, oh, Kevin's going to sit out the bull market for a year. But again, I think this is like either people like half listening because I've been very clear about that, or, I don't know, maybe people are trying to like make themselves feel good with a comment or something like that. Again, it confuses me because I feel like I'm here every single day and I do my best to be extremely transparent with my beliefs. And I'm not right 100% of the time. Sometimes I'm early, sometimes I'm late, and sometimes I'm wrong. But sometimes I'm right. And sometimes it takes time for trades to play out if there are certain trades that don't work out. Sometimes trades work out way sooner than you expect. And it's like, wow, that played out way sooner. So, but yeah, I always find it entertaining, the commentary. Oh yeah, there's some AI Buffett ETFs. Yeah, it's unfortunate. I really hope Buffett lives on for a very long time. But if you had an AI Buffett ETF right now, you'd just be selling Bank of America and Apple, I feel like. But yeah, it's unfortunate. But and then you also I hope he can. Buffett is one thing I really respect about Buffett is he is. It's not about being the greatest investor. It's about being the greatest business owner. And I find that so wonderful about Buffett. And I think the statistics are that, the vast majority of people who get wealthy from stocks are actually either entrepreneurs and they've brought companies public, or they're like early founders or early employees, and they're basically part of the startup. And it's interesting because the wealth that comes from building businesses is really similar to how Buffett has built his wealth, which is certainly cigar butt stocks of like the Benjamin Graham and Charlie Munger days. Those were great trades on market inefficiencies. Those were basically like wedge deals in real estate, right? Which I teach obviously all the time, is how to get cigar butts essentially on real estate, which is still possible, less so in the stock market. But more so after that, it's been, finding excellent businesses, putting the best management in place, and running the best cash flowing businesses. Whether it's his involvement with Geico or, even more recently, his involvement with companies like NetJets. It's really brilliant. And he's a wonderful person to model after. Big fan. Big fan. So let's see here. If stocks keep going up and valuations are even higher, wouldn't you become even more bearish? Well, it's a problem too. Is unfortunately, as stocks do continue to go higher, the upside benefit is lower, and the downside benefit or downside risk is substantially greater. But what happens is it really comes down to probably, frankly, a lot earnings in the labor market. Because if before an election and with geopolitical concerns as high as they are, if you don't have a market correction between now and the election, with all of the potential for volatility and the lack of liquidity, and you sit in an environment where the jobs market is holding up over the next two jobs reports, which I don't think you would see a dramatic rollover, but if you saw a downtrend of job loss rather than even a slight uptrend, well, then all of a sudden it's like, okay, maybe this market can stick a soft landing. Because really what you're trying to avoid is the big downside of a recession. And what would trigger a recession would be market crash during periods of high volatility, low liquidity, or rapid layoffs, which would probably come after the stock market, poopy doopy. Somebody here wrote on X, they wrote, stock market doesn't affect the Fed's decision making. Would need huge downgrade in economic growth and jobs. Inflation sticky on downside once this low. And I wrote, bah ha 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 ha, I'm sorry if you believe that. The Federal Reserve is directly influenced by the stock market for various reasons. First of all, let's start with the fact. The Federal Reserve monitors what are called financial conditions, and the stock market is a part of financial conditions. So yes, the stock market, it does affect the Fed. And number two, when the Federal Reserve sees the stock market crashing for a period of time, they recognize that it will lead companies to issue layoffs to preserve earnings per share to try to minimize the bleeding of their stocks. In other words, the stock market is directly correlated to the jobs market. You want to stop job loss? Stop the stock market from going down. That's probably why you had a Jerome Powell who gave us 50, but then said, don't worry, everything is fine, the economy is strong, because that's the best way to pump the stock market. In fact, in the videos leading up to the Fed or to the Fed decision, I said the Fed might be smart to actually prop up the stock market here, because if you prop up the stock market, you minimize the odds of layoffs. It's like the perfect 4D chess. And J. Powell played it perfectly. The question is it going to be enough to prevent the eventuality? That's the question. That's the hard thing. So like, for example, when I put together, my recession indicators, like nothing that I hear from the Fed addresses those. Nothing that I hear from the data makes me less concerned about them. If anything, I become more worried about them. We read these off yesterday. I don't really want to read them all off today, so I'll probably just put them up on screen, and you can kind of screenshot them if you want. Yeah, here it is. Updated list of recession indicators. I recently added this one, number of unemployed for 27 weeks or over. This has never increased consistently absent a recession, and it is presently increasing. Salah, I personally believe in that bonds, investments in bonds will perform very well as the Federal Reserve eventually has to capitulate. But But anyway, these items right here, this is a lot. These are a lot of recessionary considerations that, generally the counter argument to a lot of these items is, oh, well, this time is different. Oh, this time is just a normalization. I don't agree with that. T.S. Lombard even argued, earlier that, what was it, T.S. Lombard, they're like, hey, we believe in the soft landing, but we're getting nervous because some of the manufacturing data is actually problematic. Somebody says, last live stream I've been asking you about. Well, I actually think when the Federal, not now, but when the Federal Reserve capitulates, mortgage rates will plummet rapidly, and they will drive mortgage companies to the moon. This is a very challenging period of time, unfortunately, to be a bear, because you're kind of in like what's very similar to a 2007 bear market rally, where you get your 50 basis point cut. The stock market rallies to new highs for 6 weeks. After that, the stock market crashes over 50% over the next year. It's actually really incredible how similar it is to 2007. And that kind of makes it scary too. So, but anyway, we've got 4 minutes to the opening bell. For those of you curious, yes, Stock Hack is officially live. The fee structure is transparent here. The details about this are live here. You get financial consulting with my team. It's a big deal, because if you want to get wedge deals in real estate, you want to make sure you're getting a good deal on a house, on a renovation, you're not getting ripped off by a contractor, you're literally working with myself and the team. You work obviously with my team, but my team, we review your situation. We talk about your situations. We go, okay, what about this? What about this? Let's go in this direction. And the goal is really to just find what's the next best thing for you. This isn't something where, like, I see a lot of financial advisors, they'll look at sort of a profile or portfolio or somebody's situation. They're like, yeah, you should do this. And then you kind of never hear from them again. For us, the goal is to sort of be a wealth consultant, where every month or every couple of weeks, we're looking and going, what's the next best thing for you to do now? The best next step. And then hold you accountable to that, and kind of keep kicking progress. So it's like every 2 weeks. Okay, how are we going to get the next step of progress? How are we going to do next? I call this phrase myself next. All right, what's next? What's next? What's next? Best next step. That's the most important thing, I think. So learn more about that at stockhack.com, and you can book an intro call or sign up if you have enough information. But that service is going to be really awesome. And we're excited. We're going to grow it over the next, frankly, I expect decades. I think it's going to be spectacular. Okay, so going into trades here. Are members of your team yes, they are. Anybody you would talk to is going to be a licensed financial advisor, bare minimum. Like, they're probably also going to have multiple other licenses, whether they're principal licenses or otherwise. But at bare minimum, licensed financial advisor. A lot of them are also, securities licensed, securities principals. There are a lot of licenses. Attorney is on our team as well. So, anyway, okay, 1 minute to go until the bell. And, you do have a little bit of a move up here on the Qs going into the morning. Looks like Enphase up about 70 bips. Microsoft down a little right now. Curious to see how this open's going to go. You've got BTC rotating down just a smidge into the open. Apple's kind of trying to pop on this right here, so I'm interested to see how this goes. But we got about 30 seconds left to go. Financial Times, Levi Strauss warns of delay in hitting $10 billion sales goal. Uh-oh.
Teasing a jeans collab with none other than Beyonce, posting it on Instagram.
Yeah, you could cancel Stock Hack at any time if you wanted to. It's you totally have the right to cancel. No commissions, no hourly fees.
Because Beyonce had her first country album this year, right, and she had a song on the album called Levi's Jeans. So,
wow, what a tie-in. Where's the opening bell? Take a look at the real-time exchange. Here's the big board. Secretary of Energy Jennifer Granholm commemorating Climate Week. She's going to join us On such a few minutes from now, over at the NASDAQ, identity security company CyberArk. That's celebrating its 10th listing anniversary. Any broader takeaways, Sarah, on the Levi lease news being reported by the FT?
I think that it's challenging for any retail companies right now, even if jeans are popular and they're changing styles and they're doing well, just because inflation has thrown a wrench in consumer pocketbooks and it's made it harder to make these long-term targets. I guess that would be the only takeaway. That and Levi, Michelle Goss is the new-ish CEO there. She's got to keep momentum going beyond just jeans. And the good thing for her is that denim is very trendy right now. Jean jackets, jean dresses, jean skirts. We're all wearing them, and that's helpful. But there's a lot of competition, like everybody, and so that's going to be the challenge. As far as the long-term goal, last year, end of year, I think they were about a little over $6 billion. So you can see why it would be hard to achieve the $10 billion 2027 revenue target in light of that. But to your earlier point, David, if you look at what's at the top of the market right now, it's China related. I mean, everything from Tapestry to Estee Lauder to Wynn Resorts. These companies haven't had the China tailwind for a while because China hasn't done that much to stimulate. So announcing this new package of measures overnight, a lot of them having to do with monetary policy and housing, certainly giving a little bit of a hope and a boost that translates beyond just the Chinese market into a lot of these U.S. names. Nike, too. Tesla's in there as well. Tesla continuing its
it's funny.
streak.
I looked at Starbucks. That's one that's not up. But when you think about the big ones, Apple, obviously, Tesla, Nike, Starbucks.
Caterpillar, Estee Lauder, Tapestry.
And all the China stocks. Alibaba, which trades right here behind us.
Yeah,
It's up
ADR.
Pinduoduo, Alibaba.
JD.com also strong.
Yeah, you got Baba up over 6%. Perhaps there's a belief that this is only the first in what will be a series of moves meant to stimulate consumer demand.
I don't know if they're gonna hope that. That's probably a bad thing. I don't know about that. Okay, so let's see how things are going over here. We've got, let's see here. You've got Tesla still up about 1%. You've got Nvidia up about 0.5%. Then you've got, what do we have here? Q's up 21 basis points, but kind of rotating down a little bit, actually. Let's see here. Let's see. Okay, what about, trying to see here. JD still up 8.6, but it's kind of rotating down a bit. Oh, I should share the screen. You've got PDD rotating down a bit. You've got Apple rotating down a little bit. Neo trying to pop up. Interesting kind of volatility here the first few minutes. I'm not sure if it's like profit taking or what. But you've got, okay, there's the Baba Pop. Tesla had a little red candle there, but now moving up again. And let's see here. Then you've got Nvidia trying to push up as well. Qs still bleeding a bit there on the Qs, frankly. A little bit of a bleed there on ENF. Bitcoin 63.4. Interesting. Baba. Oh, Baba. Okay, let me see what the Doomers have. Let's go on over here and see what they have to say.
And the applications around that is something that we think investors aren't paying quite enough attention to right now.
Well, that's really interesting to hear you say. You say investors aren't paying enough attention to the applications of AI, but that's because we hear often on this show that it's too early to pick winners in that space. So what kind of due diligence do you have to be doing when you're trying to identify the winners on the application side?
Yeah, well, we are meeting with 20,000 companies per year. We're talking to company management. We're looking at their balance sheet, Katie. So we're doing a lot of disciplines.
AI do that for you?
Portions of it, but certainly there is no replacement. AI is the combination of the investor and the artificial intelligence. That's where we think the real magic is. But the other area that we've been focused on is international stocks, specifically areas that have strong growth prospects and strong balance sheets, areas that actually help you diversify away from the technology concentration that we're seeing in the U.S. So thinking about consumer stocks, luxury goods, pharmaceuticals, this is the kind of exposure that you're getting internationally. And when you buy those stocks, you're actually getting exposure not just to Europe, but to the entire world, because about 57% of the revenues coming into the MSCI Europe is coming from all over the world.
I saw recently also that the share of U.S. market cap relative to global market cap has reached another all-time high. A lot of people betting on America here. But to the point that you were making...
You can't get luxury. To your point, Maddie, luxury stocks are all in Europe, right? I mean...
Matt's like talking Porsche now again. I know. It's
no, but also
buying in his head.
Hermes, LVMH.
Yeah, that's what I was talking. I was mentioning in my video this morning too. This idea of like, oh, okay, well maybe the luxury stocks will move. We'll see. I actually think, honestly, I think the companies that are most exposed to China that are American companies are probably the safest bets. So like, honestly, it's probably good for a Starbucks, but there's a lot of Chinese competition for Chinese coffee, so not the biggest fan of that. I do think, NIO's obviously, NIO's just killing it right now. I think there's a chance Tesla honestly follows NIO's lead today. Yeah, you had a little profit take candle right at the open, but honestly, I wouldn't be surprised Tesla runs pretty viciously, on China news. I mean, remember, how much of Tesla is China? I'm pretty sure it's like 20% of revenue, if not 23%. Tesla, 10K. So if I go to the last 10K for Tesla, I remember the Robotaxi event is on the 10th, which I'm not like long-term optimistic on the Robotaxi event, but I do think, there's a chance you get some more running into the event. But let me look at China and their 10K. Oh my lord, I mentioned China so much in here just because of all these different sales departments that they have. Oh, okay, yeah, Command F on that one's not good. Here we go. Is this right? No. Obviously, Giga Shanghai. Okay, China. China accounts for, in 2023, $21.7 million of China Tesla revenues. So 21,745 divided by 96773. I'm sitting at about 22.4% for 2023 coming from Tesla China in terms of revenue. And that doesn't really surprise me. And so I would anticipate that would do well in sort of an environment like today where, everybody seems to be going ham for China. Obviously, you're getting a lot of volatility here, but I'm not surprised to see these Tesla candlesticks sort of skyrocketing over here. Not surprised at all. And especially at the same time as the Qs are somewhat recovering a little bit here. I'm just surprised that, they're not talking about Tesla at some of these, media outlets. But let me listen over here. Maybe they are.
In the UK at all.
Absolutely.
Yeah.
Yeah, you need to think about where that company is getting their revenue from. Another area that we're thinking about a lot is dividend-paying stocks, which I think is really interesting in this environment. So something else to think about.
I actually want to go back to those European luxury names because it ties in really nicely. As we mentioned, of course, there's China exposure there as well. And you're seeing a lot of those names, those European luxury names, have a great day after China, of course, released not quite a bazooka, but definitely a blitz of stimulus measures. When you're buying those European luxury names, when you're evaluating them, doing that fundamental research, how big of a factor is China?
Well, it's a significant factor, but so is India. So is the U.S. So is Europe. So is Japan. So we're thinking broader than just China. We are seeing a slowdown in China. We think that continues. So we're not as constructive about China as we are for places like India. Or even some of the European or Japan is another area that we're interested in looking at. So China is certainly a big bellwether and certainly a big source of consumer spending, but we're not as constructive on the Chinese economy as we were, 5 or 6 years ago.
Yeah. Maddie, great to have you.
I think this is such an interesting phrase here. This guy, Christian here says, used to be a good investor in the past, always holding and buying the dip. Do you realize how dumb that statement is? Like, yes, Kevin bought Peloton when it was, $80 and he sold it, or $100 maybe, and he sold it when it was $113. I remember selling it around $113. Oh, what a loser, what a paper hander. Why did he not diamond hand Peloton? Because all of the demand dynamics were evaporating. Oh, what a surprise. Peloton's now $4. So I guess it would have just been a good investor to diamond hand that. You realize how moronic that sounds? Oh, it should just be buy the dip. Look, if you want to buy the dip, the only thing you should regularly be buying the dip on are very diversified funds. But buying the dip on individual stocks is just like a path to bankruptcy. It's crazy. Especially when the fundamentals are shifting. So this idea, you used to always buy the dip. Man, go buy the dip on Tattooed Chef. That hit the support line as 0. I remember I was a big fan of during the COVID days when things were running like crazy. I was a big fan of Shift. And I remember I sold that sucker at like $8 because I'm like, oh shoot, volumes are plummeting. And I made a video on it too. I'm like, you got to sell. Like, volumes are plummeting. The shortages are going to kill these makers or sort of these companies, and then they go bankrupt. It's like, oh, I guess you should have just been a good investor and diamond handed. It's like the most dumb thing you could say. It's literally stupid. Like, I literally can't imagine how dumb it is to hear people say, oh, you should just diamond hand it. Maybe you should have diamond handed Sears and then they went bankrupt. Maybe you should diamond hand Red Robin Gourmet Burgers because you had a job there 10 years ago. It's insane to say diamond hand a single stock, especially when the fundamentals are changing. It's frankly just delusional.
The likes
They're
of which you're
involved
talking
in the deal.
about. Yes,
State Street.
Yes, that's right.
So they're actually selling the deal to the private equity.
And see, that's I want to be clear about that. When I say this is the level of delusion that exists out there. Like, there's a reason why we want to offer financial consulting to people to try to make sure that people who have made a lot of money keep the money they've made. Like, we're not trying to say, oh, let's YOLO everything and try to beat the market, on options. That's not what you do as a financial advisor. As a financial advisor, you look and go, okay, how do we make sure your family is safe? How do we make sure your financial situation grows in a safe way? And then if you want a speculative portion of your portfolio, that's great. But that's so much more important for so many people, and that's that consulting that's just missing because, TikTok and the internet's just like, no, just buy the dip. Come on, man. I'm literally Mr. Buy the Dip. I'm a big fan of Buy the Dip, but not when the fundamentals are going to crap. Then it's just dumb.
Can't participate. There's so much capital available to them as they stay private. I want to get to the bond market real quickly here before we head to a break. Check out how treasurers are faring this morning. Of course, we've talked a lot about the Chinese and the stimulus that they've added to their economy, in part because, of course, now at least they don't have to compete in terms of capital flight. But Sarah's made this point. We're almost 3.8. It's above where we were in yield prior to the Fed move.
3.64 was the 10-year before the Fed.
We'll be right back.
Yeah. And that's the other thing that's just remarkable right now is just what's happening in the yield space. Because really, when you look at yields, it's like, holy crap, the Fed's supposed to be loosening and yields are just popping off. I mean, let's see what the difference is between the 2s and the 10 right now. So let's pop in over here, which, by the way, this is, bad for interest rate sensitives. I think that might be why Enphase hasn't seen as much of a pop. I do think Tesla's going to do well today because of the China pop. But yeah, Enphase, barely moving, honestly. Maybe it will later. It did yesterday, later in the day. But we go to the 2-year Treasury, and, you're at 3.6. Dude, you're 19.3 basis points uninverted. Remember, recession is usually at positive 50. So just think about that for a moment. Like, that's scary. 10-2 yield curve. Let's get an actual chart of it. Stand by. Zoom out a little. You've seen this chart before. You know that the gray bar of recession is not right when you uninvert. It's actually typically when you get most, how should you put it, when you get substantially and rapidly uninverted. So when you're seeing this move of, okay, we've gone now, from breaking out, we've gone up to 50 basis points. Oh, recession. Over here, you pop up to 62. No, not recession yet. Pop up again to 99. Boom, recession. Right? And then as yields collapse across the curve, what you actually find is, as yields move down, you end up in a situation where the entire curve moves down because you're in recession and markets now have to price in the disaster, So, crazy times. Yeah. So not too optimistic there on what I'm seeing in the yield curve personally. But, they're talking about Goolsby here. Let's listen to it.
It's interesting, Jeff. You think about the calendar ahead, and there could be a lot of choppiness with the U.S. election. When you talk to clients across the globe, really, that are looking to list here in the United States, are they waiting into 2025 to bypass some of that, or trying to front run a little bit as well? We are seeing some hit the tape in the coming weeks.
Yeah, I mean, obviously, I think a lot of people are going to avoid November. We do have a number of.
Oh, sorry, Christian.
We also have some companies talking about trying to get out in December. We had a few really well-performing healthcare deals that came out post-Labor Day. We were really excited to see those continue to trade above issue price. We see a lot of private equity-backed companies considering the public markets as a way to create liquidity for their sponsors. That's been over half of the proceeds raised so far this year. And when we start to think about tech IPOs, I think a lot of those venture-backed tech companies are probably going to hold off until 2025.
And let's talk about what you've been doing in the meantime, of course, as you ride out this drought and maybe wait for those companies to come out of the pipeline into the public markets. NASDAQ, of course, has been seeing a lot of listing switches, actually. Of course, companies switching their listing from one exchange maybe to the NASDAQ. Talk us through what the courting process looks like there. I mean, what motivates a company to go from one exchange to another?
Yeah, we just achieved a big milestone, our 500th exchange transfer. It wasn't so long ago that the rules around the U.S. capital markets meant that if you changed exchanges, you had to leave your stock ticker with you. The SEC relooked at that rule a number of years ago. They gave companies the choice to take their stock ticker with them. So if you transfer from the NYSE to NASDAQ, you actually keep the same stock ticker. And that was really what unlocked our ability to go and compete for not just new listings, but existing listings. And so since that rule changed, we've had over 500 companies transfer to NASDAQ, representing nearly $2.7 trillion in market cap, measured at the time of when they make that switch. So why do they do it? A lot of it is the brand affiliation with NASDAQ. They want to be associated with the most innovative companies in the world. It's our investor relations business. So we work with companies on both exchanges in the U.S. to help power their investment.
Okay, this is boring. Let's go over here. They're on commercial. Okay, fine then. Boring. All right, so some of the enthusiasm I've noticed has started to wane a little bit here on NEO. I was somewhat surprised by that. You had, let's see here, NVIDIA's still trying to trend up, but look at the Qs. This is actually a little weird to me. The Qs trading sideways on a... That's my company, it's not boring. Well, I'm not trying to say your company's boring. I'm just saying we're not here to hear about the company right now. We're here to learn about the markets and what trading's going on, right? So it's just a different topic, my friend. So what do we have here? This is a little odd on this sort of like stimulus bazooka in China to now see the Qs rotating like this. And look at this. You've got a sideways movement on the Qs. You had euphoria, and now the euphoria is relaxed. Let me see if data's coming out here in a moment. Let's see here. Data. So data. We got S&P CoreLogic home prices coming in weaker than expected. Big deal. We get consumer confidence in Richmond Fed manufacturing at 7. So maybe there's some nervousness over that that data that could be coming out within the next 15 minutes or so here. Wow. Okay. Well, the Q's just lost another 6 basis points there. That's quite unfortunate. So I'm not entirely sure. Let me see what our. I don't think I have any lines here. We're somewhat in no man's land, going all the way down to 476. So I'll be watchful of this. But interesting to see after all of this movement that we're not getting that much enthusiasm from markets. Would have expected, again, a little bit more there. But, whatever. So, okay. Let's see here. What else do we have? Apple. Yeah, see, even Apple, it was up 1%. And it started bleeding out a little bit. But Apple should be doing well. Tesla should be doing well. I mean, honestly, up 2% is nice. But look at this consolidation already. Here's the 258 line, by the way. We typically reject off of 258. So, I'm skeptical of 258. And especially getting a consolidation, like within $1 in front of it. But let's see if we can break through. The Qs are just having some entertaining volatility right now. Let's see here. Okay. Palantir, interesting. Palantir's down a chunk. What is this? 2% here. I mean, obviously this stock has been doing phenomenally well, so you can't say anything bad about Palantir. You're going to have give back days, but it's certainly in a place where its valuation has gone a little kooky. Not trying to say that to offend anyone investing in Palantir. I'm just a fact, bro. Valuation's a little kooky dookie right now. So, little recovery there on the Qs. Yeah, see, Enphase still negative. But Enphase isn't really a beneficiary of the China trade. So that doesn't surprise me on Enphase. I think Tesla is much better. Okay, going back to 63,840 for a reject. Amazon 192 is pretty impressive. Nice impressive rebound you've had there. Let's see here. FICO, 66. Actually surprised some of the mortgage companies are green. How's Intel doing these days? Let's see here. Intel Cope. Almost $23, not bad. And then we've got, there's Nvidia still sideways. Tesla still sideways. Probably anticipation of data here. Wouldn't be a big surprise to see data concerns. So we'll see. We'll know as that data comes out in just a moment. Where were we yesterday on the Qs? I got a 476 on a retrace. 476 honestly would take a while. Like that would take a big movement to kind of get there. 476 at least in intraday of one day. If I go to 483.75, sitting. Never mind. You'd only have to be down 1.5%. Not actually that horrible. But okay, interesting. So you're at now 13 basis points on the Qs, still trying to bleed a little bit. Yeah, Tesla can't break out of this consolidation. Right here in front of this rejection. And I generally don't hold consolidations when I'm trading. I find that more money is lost holding a consolidation, waiting for the breakout, than is worth it. You're better almost off just wait for the trend to be up or down and then trade it. So what else? Well, it's got to be data nervousness. It's kind of weird. Because again, you've got data in 6 minutes. So let's see here. Somebody says Kevin's happy Tesla can't break out. That's not true. I just had calls on Tesla and made some money. So it's like I would have loved for it to break out. My calls would have printed and like lots of money on calls. So creeping up to 200% on Palantir. So I probably flippity floppity and bank 60K, but I don't know. See, this is where it'd be useful for you to have a financial advisor. What if you had, I'm just wondering, urban x urban. Let me just give an example here. Okay? So you're like, hey man, I'm up 60K on Palantir. What if right now you could text your financial advisor in my office And then my team at 8 o'clock, we're together. We're like, hey, we got this guy with 60K in profits. And then we're at the whiteboard and we're like, all right, well, what's his other net worth? How much real estate we got? How much in other assets do we have? What do we have in other bonds? What do we have in other stocks? What's income? Let's analyze the risk. Is this something, and like, if you were to take profits, how are you going to mitigate the taxes of that? If you were not to take profits and you were to hold and the stock were to fall, how is that going to affect your future goals? Right? That's the point of a financial advisor. If you just want to like YOLO and get the biggest, best return, go buy options, but obviously there's high risk in that. Yeah, but that's where, like, I don't think people realize what we're doing at stockhack.com. $420 a month gets you access to ask that question whenever you want. And then as a team, we can analyze your actual situation. We pull up your situation and we go, okay, we know this person's situation because we've been working with them for months. That's why we have a relationship that costs the fee. That's at stockhack.com. But then you can ask and you get the help you're looking for. At least you get another opinion. At least you get a professional opinion. That's like, okay, well, in your situation, maybe it makes sense to, buy more. Maybe it makes sense to trim a little. Maybe it makes sense to sell all of it. I don't know. Like, nobody can tell you because nobody knows your personal situation. This is why they say, I had some, and it's funny, I had some like dumb nut. They left a comment there like, oh my God, by the way, data in 4 minutes. Some dumb nut left a comment. They're like, why would I pay for financial advice if you can't even guarantee me a result? I'm like, nobody can guarantee you a result. Nobody can. Like, first of all, it's highly illegal. The SEC bans that. But the second thing is, everybody's trying to give you an objective opinion based on your situation. How do you mitigate risk and try to do the best with the information that you have available? That's never going to guarantee it was the perfect decision. That should be obvious, but, there are plenty of times in my life, like a long time ago, where I'm like, man, I wish I had a consultant, an advisor. So, oh well. So, okay, Q's still struggling. Yeah, learn more about that over at stockhack.com. Anyway, Q's moving a little sideways right now. You can see all the fees at stockhack.com. If somebody promises a guaranteed result, it's probably a pyramid scheme. Yeah, that's exactly right. Yeah. So, okay, data coming out in now 3 minutes. I'm excited. You know what? I need, Kevin, tax advice. We work with a CPA that works for us full time. A couple CPAs actually. So we're not tax advisors, but we've been trying to figure out how could we set it up to where we could actually. You can give tax advice from the point of view of a financial advisor, but not from a CPA point of view unless you're a CPA. So, but I wonder, since we're working with a CPA, if we can just run people's situations by them. We probably will. But, we want to figure out how to, we'll figure something out for that. But, yeah, it's kind of exciting. Consumer confidence index today. Yeah, this is, you get consumer confidence, present situation, expectations, Richmond Fed manufacturing index, and business conditions. Yep. Yeah. Who is my team? They're licensed professionals that, have been working with me for 2 years now. And, the way to look at it is like, the team is the conduit to the meet Kevin opinion. That's the way to look at it. I just can't be on the phone with everybody, but I can clearly communicate with my team, and we can help people's situations. But there's no way to scale, me being on the phone with everybody. It'd be impossible. Yeah. So stock hack for you in the UK as well. I know we can do Canada. Yeah, we can do Canada. I don't know if we can do UK. Maybe email us, staff at stockhack.com, and, we can kind of advise from there. So, but anyway, we're about to get data. We're now about, 15 seconds-ish from data. Kind of excited to see what happens here. And let's find out. Okay, Richmond Fed manufacturing, worse than expected. Consumer confidence, well worse than expected, not great. And then you've got present situations and expectations. I'm still waiting for those. Let's see here. Okay. Are they going to cover it? No, they're not. Present situation comes in well below the prior. We didn't have an estimate on this, but we got actual consumer confidence coming in at 98.7 versus the expectation of 104. Prior was slightly revised up, slight revision up on the prior, but the Richmond manufacturing one was bad. Consumer board expectations and present situation, those came in worse than prior as well, so not ideal. And then it looks like, I want to see if there's a response over here yet. Are they covering this yet?
Though just turning negative, it was positive earlier this morning. If you look at what's working, China-related names like materials and energy on top of the market, but financials, communication services, healthcare, and real estate all down. We're also just turning red on all three of the major averages as we speak. Apple's up, Tesla's up, but Microsoft and Meta are lower, so mixed picture in technology. As for treasuries right now, selling continues, a little bit firmer yields. That's been the story post-Fed. Nothing extreme. We're still below 4% on the 10-year, below 3.8%, I should say, at 3.77%. But we're going to get some data here in just a moment on consumer confidence, PCE, spending, incomes, and inflation later in the week. Let's go to Rick for that, right?
All right, yeah, let's do it. Economic data crossing the tape. Rick Santelli has it for us. Rick.
There we go.
Yeah, we are looking at some big misses here on consumer confidence. We're expecting a headline number to be around 104. 98.7, 98.7. That is the weakest going back to February of 21, July of 22, when it was 95.3. So these are definitely weaker than expected numbers. Now, let's go towards present situation, 124.3. Also a very big miss. That's the weakest since March of 21. And here's something very fascinating. This now, if you look at the July read, that was the weakest since April of 21. So we are really looking at present situation deterioration. And if we look at what lies ahead in the form of expectations, minus 81.7, and that's the weakest, well, just since July of this year. Now, let's switch gears towards Richmond Fed. We have both manufacturing and service indices. On the manufacturing, minus 21, which means it's 11 consecutive negative number in a row. And here's something fascinating. If we look at the business side of it, the service sector, it's minus 3. Our last look at minus 13, well, it was the 30th negative number in a row. So minus 3 is definitely a big improvement, but it's still 31 negatives in a row on service sector with respect to Richmond Fed. So we are looking at yields moving a bit lower on the long end. And do keep in mind, the long end is on pace for its fourth consecutive higher yield close in a row. Every close since last Wednesday's 50 basis point cut by the Federal Reserve. Sarah, back to you.
Okay, Rick Santelli. Rick, thank you very much. Adding that weaker consumer confidence into the mix today. The big story, though, is China, and that's what moved things overnight. The Chinese stock market went up 4%. China-related names of the American companies that do business there, some of the ADRs, the Chinese companies that trade in the U.S., at the top of the market today. Why? Well, this sort of rare, publicized, coordinated set of measures announced overnight to try to boost their economy, mostly from the central bank. So they lowered rates, a key short-term rate. They announced plans to basically reduce the amount that money banks have to hold in reserve to the lowest level in a few years, try to stimulate lending, boosting liquidity to the stock market, lowering a key rate on mortgages, and also easing rules for second home purchases because the housing market has been a source of weakness there. Add it all up, and it's a strong sign that China wants to try to boost their economy. This Fed made it easier, too, because of the sort of jumbo rate cut that we got last week. But going through the commentary today, from economists, it's not the fiscal big bazooka that necessarily markets were hoping for and economists think is needed to stimulate demand on a more sustainable basis for China and get them out of this, almost decade-long deflationary slump that they've been dealing with as well. But for now, it's helping. Certainly helping sentiment, helping stocks moving after some of these stocks have been so depressed, especially in China over the last few years on lack of measures and
6 years
growth concerns. So that's in the mix today.
Yeah, and it's getting a very positive response. Of course, you can see some of the names that would benefit from a stronger Chinese consumer, led by the likes of Alibaba, PDD, of course, which owns Temu, JD.com. We'll go on and on from there, Sarah. But again, you know, is it really getting at the ultimate problem, in part, which is lack of confidence, much of which comes from the property sector, significant fall in real estate, and or if you're unlucky enough to actually own a building that never got completed, things of that nature that really are at the heart of so much of the weakness that I think you've seen in that consumer in China.
And that's why economists view the fiscal spending to boost demand, household demand and spending as the missing ingredient here. Maybe they'll be more willing to do it now that they've shown some more force in terms of stimulus. You know, it's interesting contrast to what we're seeing here in the U.S., which is mostly better news on the economy. I know Rick just mentioned the weaker consumer confidence, but overall, I was looking this morning at an economic surprise chart. So this measures basically where the economic data has come in relative to expectations. And when it's better, it ticks higher. And if you look at that chart, it shows that we've been on an upswing here when it comes to economic data. There toward the end. So it was weak. Remember the growth scare heading into early September at the end of summer as we were missing and the labor market is softening, and now a little bit better than expected. Maybe people got too negative about what's happening on the economy as we're tracking for an almost 3% growth rate in the third quarter, according to Atlanta Fed. So our economy, this is what the soft landing or the soft patch or whatever you want to call it is that's keeping the market optimistic at the same time that the Fed is cutting rates. You know, Jamie Dimon of JP Morgan spoke to TV18, our counterpart in India, and did talk about this whole market setup and why he's been a little bit more skeptical. Listen.
You know, I think the stock markets and the bond markets are pricing in a soft landing. But you also look at the stock markets are generally very high, and bond spreads are very low. And, you know, that's kind of Goldilocks. And that may very well happen. I mean, I'm hoping for that. I just give it a lower odds than the market does.
He continues to give it lower odds.
And by the way, I think he's on television or saying it somewhere every day. I mean, he's very determined to let everybody know how he's thinking.
Right, which is he's more cautious. He used stagflation in recent weeks.
He has been more cautious for some period of time, as we know.
Maybe it's a little bit of a JP Morgan as the port in the storm kind of framing, because that's been the case. If you want to look at it at self-interest.
Sarah's awesome. Okay, cool. So, damn, that was nice. Yeah, just traded on that data and pretty much a double on that trade. So I'm gonna take it. That was sick. But, yeah, that's crazy. So, and it's remarkable because it was like when CNBC started talking about it, like 2 minutes later, like trades were already in, you know? I was like, damn, I'll take it. But yeah, no, we should actually look at this data. Consumer confidence, board. So consumer confidence, and let's see what's going on here. Oh, come on. The website is loading so slowly right now. There it is. All right, I got it. All right, let's get the details of what's actually in this report. Could be a poop show for all we know. Okay, give me 1 sec to save this. Yeah, the Qs are consolidating right now. So, and then let's see, Tesla just legged lower, but it's also consolidating. Oh, jeez. All right, let's take a look at this. All right, so consumer September's decline was the largest since August of 2021. Yikes. And all 5 components of the index deteriorated. It's just like not good. Okay. Wow, this is terrible. Consumer assessments of current business conditions turned negative. While views of the labor market situation softened further. Why is this such trash? Hold on a sec. Let me go to this. One sec. All right, I gotta switch to everyone's favorite mic. You know, I don't. Everybody poops on this mic. I honestly, I think this mic sounds better. I think it. Like I had the settings wrong on it for a while, but I don't know. I kind of think this mic is freaking sick. Anyway, you know, I just gotta keep showing up, keep putting the work in, even with the haters. Don't give up. So, consumer, that goes for everyone, by the way. I know, you know, we often talk to people that got like, you know, I lost a job or whatever, or you know, a business opportunity didn't go the way they thought it was going to, and it's so like the easy default in life, honestly, is just to give up. September's decline was the largest since August of 2021, and all 5 components of the index deteriorated. Consumer assessments of current business conditions turned negative. Okay. So let's highlight that a different color. Consumer assessments of current business conditions turned negative, while views of the current labor market situation softened further. Consumers were also more pessimistic about future labor market conditions and less positive about future business conditions and future income. Now, this should technically actually increase consumer savings. It's actually fascinating. If you look at this, consumer savings usually go up when pessimism about jobs and the economy rises, specifically in recessions. So this I find very interesting. If you look at like the savings rate plummeting, a savings rate usually plummets before a recession as consumers spend their last available dollars. Kind of interesting to think about as well. Okay, the drop in confidence was the steepest for consumers 35 to 54. That's like all of us. As a result, on a 6-month moving average, the 35 to 54 group has become the least confident, while consumers under 35 remain the most confident. Well, yeah, because they haven't been through a recession. You know, I mean, think about that. Those under 35, like your downside risk isn't that high, whereas over 35, you could lose a substantial portion of your net worth. So there's a little bit of a delusion amongst usually the younger cohort. Keep in mind, I'm 32, so I get it. But I was old enough to still be a part in the market of the tail end of the 08 recession. But I remember, you know, what friends, family, and businesses went through in 08. I remember it vividly, and I remember the pain. So I try to resonate with it. But anyway, confidence declined in September across most income groups, with consumers earning less than 50K experiencing the largest decrease. On a 6-month moving average basis, consumers earning over 100K remain the most confident. Well, that's good because that's also your Tesla buyer right there. But, you know, what happens when those people start losing their jobs? Deterioration across the indices' main components likely reflected consumer concerns about the labor market. Even if slower payroll increases and fewer job openings, even if labor market remains quite healthy with low. Oh, jeez, Lord, are you serious? You're gonna format me like this? Hold on. Let me see what's hiding behind that stupid C-suite crap. Wow, CEOs remain more cautious too. This is just bad. Everyone's pissed. Hold on. There we go. Okay, so labor market remains quite healthy with low unemployment and few layoffs. The proportion of consumers anticipating a recession over the next 12 months remained low, but there was a slight uptick in the percentage of consumers believing the economy was already in recession. Ooh, I believe that. Somebody here says W for accidentally buying Palantir puts at market open instead of AMD. Palantir is substantially overvalued. I think it's a fantastic company, but it's substantially overvalued. And congratulations to you. Yeah, it's down like 3%. Man, yeah, that's not a good report. We'll keep going through it here in a moment, but I think this sort of just like reiterates what we're seeing in this report. It kind of reiterates why it's so important for people to talk to a financial advisor. It doesn't even have to be us. Yeah, it's stock. I mean, I talk about it now because we just launched it. It's kind of exciting, but it's unfortunate because most people won't talk to a financial advisor, and they really should. The people who really need to the most probably won't. And remember, with stock hack, you can cancel at any time. I think that's worth knowing. The deterioration across the main index also reflected consumer confidence about fewer hours, slower payroll increases, fewer job openings. Let's see here. Share expecting lower interest rates increased. Share expecting higher interest rates decreased. Despite slower inflation, average 12-month expectations increased. Oh, that's not good. Nonetheless, measures are well below what we saw in March of 22. While positive, both expected their financial situations to weaken over the next 6 months. Against this backdrop, consumer buying plans for big-ticket appliances were mixed, and plans to buy a smartphone laptop in the next 6 months eased. Purchases for a home and car improved slightly, probably because they think, rates are going to come down enough to actually help boost them. Wow, that was a poopy-doopy one, eh? Yeah, let's just take a peek at how markets are reacting to this. Somebody says everything is fine. Yeah, it's crazy. It's crazy. Somebody says Tesla pumping. I mean, not like it was at open. Somebody says, my system is telling me to go short SPY here, but there's a 25% chance this is the exact bottom. I generally don't play the SPY. I play Qs, but it looks like it's a similar pattern to honestly what's going on with the Qs. The problem is, I don't think you have enough pain to really pull you all the way down to 476 right now. You might get a continuation of this pain tomorrow. Yeah. Poopy doopy times to someone. Time to get a baby makes you feel better. Yeah, no kidding. CEOs quitting lately, being cautious. How is Michelle Bowman a governor? Yeah, no kidding. How she talks about inflation just makes me feel like she's never read an earnings call in her life, honestly. I didn't have a put on Tesla. No, I see somebody in the comments here suggesting I had a put on Tesla. No, I had a put on the Qs. So I traded Tesla with a call. When it consolidated, I sold it over here. So I probably got in somewhere over here in this. It might have been like right here as this candle was dipping. So like for a second, it went upside down. But then when it ran up here, I took my profits during this consolidation. So once I saw this consolidating, I'm like, I'm not going to hold this. I'm gonna sell this. And then on Qs, I bought the Qs right when the data came out. So I had the order ready to go. And as soon as I saw the data was a miss, I just went, boop. And I put my limit order in, and it filled instantly. And I'm like, let's go. Because it doubled in like 5 minutes. So, yeah. It really didn't make the most money, I feel like, until CNBC started yapping. CNBC kind of really drove it down more. But, yeah, I'm surprised, honestly, to see the Qs negative in the face of stimulus. Somebody here says, I lost everything in 08, and now I'm technically rich again. This game rules. Well, you're the kind of personality we need to be consulting. Yeah. Stockhack.com. Sign up. again, you could cancel at any point. Our goal, and I tell this to everyone in the office, the goal is to provide so much value that people are like, how could I live without having my financial consultant? So, you know, like, we want to give you so much value that you're like, I want to be part of this forever. That's our goal. So, that's always been my mantra, is provide more value. You know? So, anyway. Well, go check that out, StockX.com. I appreciate y'all. And, hey, you know what? We'll see you in the next one, all right? I'm going to push the button here. I got to get to the course member live stream. Even though I'm a licensed financial advisor, real estate broker, and becoming a stockbroker, this video is neither personalized financial advice nor real estate advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show should not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purpose of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services which we may benefit from. I personally operate and actively manage the ETF and hold long positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuers other than HouseHack, nor am I presently acting as a market maker. All right, y'all, we love you. We'll see you in the next one, all right? Goodbye. Good luck out there.